welcome to our press conference on the Autumn Economic Forecast 2019. The press material is all published now, as is the forecast. You'll also find material outside the press room, and I'll hand over the floor immediately to Commissioner Moscovici.
Bonjour.
Hello everyone. I'm delighted to be here for these Autumn Forecasts 2019. I'd said goodbye to the press room about a month ago, actually, but as things turn out, I'm still around. That was a bit unexpected. In a press conference, I had at one point say that I would be a commissioner as long as there are Italian journalists to ask me questions about the Italian economy, and I'm still a commissioner, and I'm still happy to give news about the Italian economy and any other subject, although that's not the main subject for today. What are the main messages for 2019, the forecast, and for 2020 and 2021? Well, first of all, the fundamentals of the economy are robust. In 2019 and 2020 and 2021, there's still years of growth. We have years of growth ahead in all the countries of the Eurozone. The labour market continues to improve and will remain relatively good over that period. And the public deficit in the Eurozone will be well contained and shouldn't exceed 1% of the GDP by 2021, which shows that the efforts that we've asked for are having results over the long term. Now, that may sound very good, but I need to mitigate that. European growth has a brake on it, and that's the tensions and trade uncertainties, to which you have to add the weakness of demand and structural changes. And all this is a brake on manufacturing industry in particular. Third, inflation. Inflation had a slowdown, which reflects mainly a drop in energy prices, a slowdown in economic activity, softening of external pressures on those prices, should keep Eurozone inflation low, about 1.2% this year, and 1.3% in 2021. Now, all this has consequences on monetary policy. It's not here that we do monetary policy, but if you have long-term low rates, I think that's probably about right. Now, growth will remain moderate, but positive in all member states. In the Eurozone, 1.1% this year, 1.2% in 2020 and in 2021. And in the European Union as a whole, growth should be 1.4% for each of the years of this forecast. Finally, I can't hide the fact that over the future there are downside risks which continue to have an effect on economic forecast, increased uncertainties, of course the trade tensions that you're aware of, geopolitical tensions that you're also aware of, or even a greater slowdown than expected of the Chinese economy. Those are the external risks that we have to face internally. Disorderly Brexit can't completely be excluded, and contraction in the manufacturing industries could contaminate the services sector, of course, which supports the growth in other activities than manufacturing per se. And after 6 years of robust growth, the European economy is moving towards more subdued growth. The economy has slowed down in the second quarter of 2019, and we think it's unlikely that it will pick up, that it will rebound in the short term. And that tends to be confirmed by the flash Eurostat estimates, where quarterly growth in the Eurozone was stable, point-something% in the third quarter of 2019, and all available indicators suggest that things will be roughly similar for the fourth quarter of the year. Basically, what I'm saying is after growth of 1.9% last year, there's to be a slowdown of that to 1.1% this year in the Eurozone, and growth more or less the same in 2020 and 2021. And that may be, I suppose, a thread running through this quarter's forecast, the lack of a bounce. It's a change, with respect to previous forecasts. It reflects some of the shocks that have hit the Eurozone area, and we know that the impact of these shocks will take a certain amount of time to be properly absorbed and a return to moderate growth. It's the sign, I think, of a new kind of period, and I'll return to the cause for all that shortly. Private consumption remains solid, and that's basically what's supporting growth. Purchasing power of households is supported by growth in employment, which continues, and an increase in revenues in salaries at a time of low inflation and low borrowing costs, which are historically low. Budgetary measures taken in certain member states will probably help support that growth as well. Investment by business, however, is going to suffer because of uncertainties and because of weak global demand. But, of course, financing costs are low, and there's also support from, for example, the European Fund for Strategic Investment, which is a factor, amongst others, which will contribute to supporting investment. However, it's unlikely that all these factors supporting internal growth, domestic growth, will stimulate growth by 2020 or 2021 at a significantly higher level than this year because of the persistent trade tensions, the political uncertainty, structural change. Think about consumer preferences in cars, for example, which are shifting. All these things mean that Europe is on a trajectory of subdued, moderate growth over the next few years. And I think that's the main teaching of these forecasts. The European economy, the environment, well, it's impacted by global slowdowns over the summer, greater tensions and trading uncertainties, of course, between the US and China, first and foremost, have already had a negative impact globally. And, of course, a consequence of that is that the forecasts for growth of the economy have been revised downwards, and there's a contraction of the manufacturing sector, which simply reflects those tensions and which continues in a climate of uncertainty, and it's almost becoming a structural fact. American economy, we know that the problems they have at the moment are cyclical, but that's not true of China, where the slowdown is caused by structural factors such as an aging population and such as high levels of debt. And this explains why the Chinese authorities are trying to rebalance the economy by reducing overinvestment. And then there's the potential for a rebound in the emerging economies, which is slowed down by difficult financing conditions and the global tensions and the cost of raw materials, which are low. But setting up economic policies to support growth in a certain number of countries, and that includes the US and China, and the strength of the labour market, should limit the extent of the growth slowdown in the global economy. We believe that having progressed by 3.8% last year, growth globally outside the European Union will probably go down to 3.2% for 2020-2021, possibly a little bit above that, up to 3.3 or 3.4% in 2020-2021. We're slightly more optimistic than other institutions have been on that point. Now, against that backdrop, the growth in global trade has slowed down in the first half of 2019, and there's no sign of a pickup. This weakness goes hand in hand with a strong slowdown of industrial production and global investment. The contraction, which I mentioned earlier on, in imports in the emerging economies was greater, in particular in China and in the Asian economies. Advanced economies resisted rather better because of what I was talking about earlier on, which is the resilience of domestic demand. Now, all this translates into figures, into the fact that the growth of imports globally outside the European Union will go down from 4.1% in 2018 to only 0.4% That's a collapse in that figure, and things should pick up in 2020, 2021 to 2.1% and 2.5% respectively, which remains rather below any long-term trend. Now, this has an impact, of course, on manufacturing industry, which for more than a year now has been contracting following the global situation. Sectors which are focused on internal demands like services and building do continue to grow. Germany is, of course, the country which is most affected by a contracting in manufacturing industry because of what everyone knows, the high share in their economy of those industries in their GDP, but also the importance of industrial products in their exports. Central European economies and Eastern European economies have continued on a path of strong growth because of very dynamic labour markets and because of their ability to absorb European funds. A constant paradox, by the way, that in countries where they most criticise the European Union, these are precisely the countries where their growth in their economies and employment is caused because of Europe. I think this sets some of those political positions that we see adopted into context. That's a bit outside my proper role, isn't it? And I'm expressing myself a little more freely than I would previously in my mandate. But as I said, the slowdown in activity does affect these economies because any contraction has contagion through cross-border production chains, manufacturing chains, which we're likely to see. All this means that the European economy has to base itself on national, domestic growth. Private consumption, which, as I said, was resilient, will probably go down slightly this year. Why? Well, because of savings. Consumption should continue to at levels which are roughly similar in 2021. Investment by business will probably continue to go down because of uncertainties, drops in profit margins, and expectations which are lower. And the growth of the Eurozone may well be neutral in 2021, possibly even slow because of the slowdown in the external environment, which will be tempered by time. Now, as I said, the potential for growth in employment is probably more limited now, particularly in manufacturing industry, which is only logical given what I've just said, given the growth in manufacturing industry, where build-ups in labour levels has already taken place. We can't expect many more jobs in the manufacturing industries. Data in the European Commission on labour perspectives suggest a marked drop in growth in employment. Manufacturing industry and services diverging, which suggests a difference in performance levels between the two sectors. Nonetheless, and this is very good news, the situation on the labour market remains relatively good, with slower growth than before. Sectoral policies in lower productive areas, the growth there should enable increases in employment despite the paradox, which is in fact only apparent. 7.6% drop to 7.4% in 2020, 7.3% in 2021. Across the European Union, 6.3% across the European Union, 6.2% over the next 2 years for unemployment. So you can see that the trend is stable in unemployment because there is this constant, reasonable expectations. I switch to English.
I thought that I could do it in French totally for the last session, but well, that's not how things are in the Commission, not yet. We'll see what happens with Brexit. As I always said, after Brexit, English is forbidden everywhere. But don't worry, it's just a joke. It will be very strong for those who are attached to it. In the euro area, monetary policy remains supportive. Upward pressure on nominal interest rates should stay very limited, due to the subdued growth and inflation outlook, as well as recent ECB decisions. As you can see on the chart, which is behind me, real short and long-term rates are likely to remain negative in the period ahead. Funding costs for the private and public sectors are thus also expected to remain very supportive. Euro area inflation has been on a downward trend in 2019, largely because of falling energy prices. Core inflation, the inflation which excludes energy and unprocessed food price developments, remained also very low. In a context of weak demand, firms have been absorbing labour cost increases by accepting lower profit margins rather than by raising prices. Inflationary pressures should remain muted given the subdued growth forecast and the assumption of moderately declining oil prices. So the figures are such that in the euro area, inflation is projected at 1.2% this year and next at 1.3% in 2021. So now I move to the European Growth Map 2020, saying that I'm sorry that it was leaked and that I deeply regret that, and that is something that cannot remain without an internal inquiry, because you are the ones who should have the exclusiveness of those figures and nobody else. Among the largest economies, GDP growth is expected in 2020 to be at or above the EU average, only in Poland at 3.3% and in Spain at 1.5%. Growth in Germany should pick up to 1% in 2020 after 0.4% in 2019. Part of this, however, reflects a higher number of working days next year. Underlying growth dynamics are set to remain quite subdued. Domestic demand should prove strong enough to generate growth as private consumption continues benefiting from robust wage increases. S'agissant de la France, nous prévoyons une croissance de
1.3% for France in 2019 and 2020. Why? Because private consumption, supported by ongoing good prospects on the labour market and budgetary measures, should be strengthened and compensate the drop in investment which you see across the European Union. Italy,
just 0.1% this year and by 0.4% in 2020. A positive contribution from net trade this year and moderate growth of household spending next year should help the economy. Domestic demand is unlikely to be boosted much by the labour market, as employment and wages are set to grow only very moderately. In Spain, as I said, real GDP growth is expected to continue decelerating from 1.9% this year to 1.5% next year, which is still well above the EU and Eurozone average. Private consumption growth is projected to remain subdued as households are forecast to increase further their precautionary savings amid growing uncertainty. In the UK, still for the time being an EU member, so we have to forecast it, and growth is set to be at 1.4% over the next 2 years. There's still a relatively robust real wage increases in employment growth should support private consumption, but continuing uncertainty about the UK's future relationship with the EU is likely to weigh on business investment. So I must recall that our forecast is based on a purely technical assumption of status quo in terms of trading relations between the EU27 and the UK. Now let's move to public finances. In 2018, the aggregate public deficits of the EU and the euro area fell to their lowest levels since 2000. Over the next 2 years, the euro area deficit is expected to increase only slightly from 0.8% in 2019 to 0.9% in 2020 and 1% in 2021. The euro area aggregate fiscal stance, which is measured by the change in the structural balance, is projected to remain broadly neutral. Concerning public debt, the euro area's debt to GDP ratio is set to decline further from 87.9% in 2018 to 84.1% in 2021. Similarly, in the EU, debt is expected to decline from 81.9% in 2018 to 78.4% in 2021. This deleveraging should find support from nominal GDP growth remaining higher than the very low implicit interest rates paid on outstanding debt. Although the aggregate euro area deficit is forecast to increase in 2020, all euro area member states are projected to run deficits of less than 3% of GDP. That's an old story now. Within the EU, only Romania is forecast to have a deficit well above 3% of GDP in 2020. Among highly indebted countries, the picture in terms of deficits is varied. Deficits are set to increase in Italy and Belgium, but too narrow in France as a negative impact of a specific one-off measure called the CICE, which I know well, having been responsible for its creation a few years ago, affecting 2019, fades now. Two countries where the turnaround in public finances had been particularly striking are Portugal, which is projected to run a balanced budget next year, and Greece, which plans a large surplus for 2020, in line with the commitments made under the enhanced surveillance procedure. And having dedicated quite a bit of my time for those two countries, these are good news when leaving the Commission. Several countries that have been running surpluses will see these decline in 2020, mostly due to expansionary fiscal policies in Denmark, Cyprus, Netherlands, Luxembourg, and to a lesser extent, Germany. As I said in my introduction, the EU economy faces a period of high uncertainty related to trade and other economic policies. Downside risks to the outlook remain highly interconnected, which should magnify their impact. These include further increases in uncertainty, which could lead us to a worse outcome than envisaged, a further escalation in US-China tension, although this is not a tendency right now, and a sharper than forecast slowdown in China. Within the EU, negative spillovers to other sectors from the manufacturing construction might build up, and this could finally impact jobs and confidence and weaken private consumption. A failure to secure an orderly Brexit would also affect growth, although more so in the UK than in the EU27. Finally, to end up on a more positive note, it's clear that the de-escalation or a resolution, who knows, of economic and trade tensions would boost economic growth both outside and inside the EU. To conclude, I would say that the road ahead for the EU economy is obviously challenging now, even though all member states are expected to grow still in the coming years, but as I said, at a very moderate rhythm. Given the numerous risks, we must intensify efforts to further strengthen the resilience of our economies and of the euro area as a whole. Mario Draghi, to whom I want to pay tribute today, is right. Monetary policy alone cannot carry the burden when the economy is weakening. Ministers had a constructive discussion on last Eurogroup on the fiscal stance in the euro area. It will be for the new Commission to provide the necessary steer in the coming months and years. I expect also quite a bit of continuity, and I hope this will be the case, but that's not my business anymore. I'm now ready to take your questions.